As a small business owner, you wear many hats. You are the CEO, the marketing director, the head of sales, and often, the janitor. But the most intimidating hat you might wear is that of the chief financial officer. Making smart money decisions is critical to your survival and growth. One of the biggest financial questions you'll face is how to structure your business. It's a decision that has massive implications for your taxes, your personal liability, and your peace of mind. Here, in 2025, the choice often boils down to two popular options: the limited liability company, or LLC, and the S-Corporation, or S-Corp. Choosing correctly can save you thousands, even tens of thousands of dollars every single year. Many entrepreneurs I talk to are confused by these terms. They hear conflicting advice from their friends, their family, and even from so-called experts online. First, let's talk about the limited liability company, or LLC. Think of an LLC as a protective legal shield. Its primary purpose is to separate your business assets from your personal assets. If your business gets sued or racks up debt, it can help protect your personal car, it can help protect your house, it can help protect your savings account. This is a huge step up from operating as a sole proprietor where you and your business are legally the same entity. Creating an LLC is usually a straightforward process done at the state level and very popular with new entrepreneurs and small business owners. Here's a crucial point that trips people up. An LLC is a legal structure, not a tax structure. The IRS doesn't have a tax form called LLC. The IRS treats an LLC as a disregarded entity by default. In short, the IRS looks straight through to you, the owner. If you're the single owner, the IRS taxes you as a sole proprietor. If you have two or more owners, the IRS taxes the LLC as a partnership. Both are pass-through taxation methods. Now let's turn our attention to the S-Corporation, or S-Corp. This is where things get interesting. Unlike an LLC, an S-Corp is not a legal business entity you form with the state. You can't just go to your Secretary of State's website and say, "I want to form an S-Corp." Instead, an S-Corp is a tax election, a special status you ask the IRS to grant. It's applied to an underlying business entity, typically an LLC or a C corporation. You start with a legal entity and then you tell the IRS, "Please tax my company as an S-Corp." File Form 2553 to make that election. S-Corp are pass-through entities like a default LLC. The corporation itself doesn't pay federal income tax. Profits and losses pass through to owners' personal returns. But the S-Corp changes how profit is treated. If you work in the business, you must pay yourself a reasonable salary as an employee. That salary is subject to payroll taxes, Social Security and Medicare. The remaining profit is paid as a shareholder distribution. It's time to put these two structures in the ring together and compare them head to head. The fundamental difference comes down to how they handle the profits your business generates. With a default LLC, every single dollar of net profit is considered earned income in the eyes of the IRS. This means the entire amount is subject to ordinary income tax and the full 15.3% self-employment tax. There is no way to separate your role as the owner from your role as the worker. You are one and the same, and all your profit is taxed accordingly. This is simple but can lead to a punishing tax bill as your income rises. The S-Corp, on the other hand, allows you to create a critical distinction. It lets you separate your role as an employee from your role as an owner or shareholder. As an employee, you receive a reasonable salary for the work you perform. That salary is subject to payroll taxes, the employee share of FICA, the employer share of FICA, which adds up to 15.3%. To truly appreciate the S-Corp advantage, we need to zoom in on the self-employment tax. Many business owners focus solely on their income tax bracket, but self-employment tax is a separate flat-rate tax that can take a huge bite out of your profits. It is composed of two parts, 12.4% for Social Security, up to $174,900 in 2025, and 2.9% for Medicare with no income limit. Together, these total 15.3%. For a traditional W-2 employee, their employer pays half, 7.65%, and the employee pays the other half. But as a sole proprietor or default LLC owner, you are both the employer and the employee, so you get stuck paying the entire 15.3%. This is where the pain really sets in for a successful LLC owner. Let's say your business profit grows to $150,000. As a default LLC, that entire $150,000 is subject to the 15.3%. That's a tax of $22,950 before you even start calculating your regular income tax. It feels like a penalty for being successful. Every dollar of profit you make gets hit with this extra layer of tax. While the tax savings of an S-Corp are compelling, it's not a one-size-fits-all solution. A smart business decision involves looking beyond the tax numbers and considering the real-world costs and administrative burdens. The default LLC shines in its simplicity and low cost. Startup paperwork is generally minimal. Annual compliance is often just an annual report and a small state fee. Income flows to your personal return via Schedule C. No separate business tax return. Saves on tax prep fees. In contrast, the S-Corp brings more complexity and higher admin costs. Maintain S-Corp status by following corporate formalities. Hold annual meetings for shareholders and directors. Keep minutes of those meetings. You must run reasonable payroll for yourself as an employee owner. Set up a payroll system. Withhold payroll taxes. File payroll reports like Form 941 and Form 940. That adds bookkeeping and compliance the LLC owner avoids. S-Corp costs are higher. Expect to pay for a payroll service. Payroll services can cost $40 to $100 plus per month. Given the trade-offs, how do you know if the S-Corp election is the right move for your business in 2025? The ideal candidate for an S-Corp is a business owner who fits a specific profile. First and foremost, your business must be consistently profitable. If your business is just breaking even or has very little profit, the tax savings from an S-Corp will be minimal or non-existent. The administrative costs of running payroll and filing a corporate tax return would likely be more than any tax you would save, meaning you would actually lose money by making the election. As a general rule of thumb, I tell my clients to start seriously considering an S-Corp election when their business is generating at least $40,000 to $50,000 in net profit after they have paid themselves a reasonable salary. At this level of profit, the self-employment tax savings begin to significantly outweigh the additional administrative costs. For example, if you have $40,000 in distributable profit after your salary, you would save approximately $6,120 in self-employment tax, 40,000 times 0.153. This easily covers the $1,500 to $2,500 in extra annual costs for payroll and accounting. The S-Corp is particularly well suited for service-based businesses where the primary asset is the owner's expertise. Consultants, graphic designers, architects, real estate agents, independent contractors. We've explored the legal shields, the tax rules, and the real-world implications. We've run the numbers and weighed the pros and cons. So in the 2025 tax showdown between the S-Corp and the LLC, who wins? For the majority of profitable, active, service-based small businesses in the United States, the champion is clear, the S-Corp. While the LLC provides a crucial legal foundation, it's the S-Corp tax election that delivers the knockout punch when it comes to saving money. The ability to pay yourself a reasonable salary and take the rest of the profit as a distribution is a game-changing strategy. The savings on self-employment tax are not trivial. As we saw in our examples, this strategy can easily put thousands or even tens of thousands of dollars back into the business owner's pocket each year. This is money that can be used to accelerate growth, build a safety net, or improve your quality of life. For a business with $100,000 in profit after a reasonable salary, the annual tax savings can exceed $15,000. It is, without a doubt, one of the most powerful tax-saving tools available to entrepreneurs today. Your call to action is this. Take an honest look at your business. Project your net profit for 2025. If that number, after you could pay yourself a fair salary, is likely to exceed $40,000, it is time to have a serious conversation with your tax professional about making the S-Corp election. Don't let fear of paperwork stop you from saving thousands of dollars. Project your profits. Consult your tax pro. Make the winning choice for 2025.